What if I told you the cost of borrowing money in Ghana just dropped for the first time in months? This is Kenya News Update today. Coming up, you'll discover how a tiny percentage point change could mean millions in savings for businesses and families across Ghana. Meet Dr. Johnson Asiama, governor of the Bank of Ghana. His decisions are about to put more money in people's pockets. But here's the twist. This isn't just about one rate cut. This is the climax of a financial roller coaster that started a year ago. The Ghana reference rate, the key benchmark banks use to price every loan, has just fallen to 15.68% for January 2026. That's down from 15.9% in December. A small drop, right? But here's what nobody's talking about. This rate was at a staggering 29.72% just 1 year ago in January 2025. That's a seismic shift. But here's the part that will blow your mind. This isn't an accident. It's the result of a calculated battle against inflation. The decline was driven by improvements in key indicators, including the monetary policy rate, treasury bill rates, and interbank market rates. Some commercial banks told Joy Business that marginal improvements in inflation and treasury bill yields also contributed. And then, something shocking happened. In December 2025, the GRR fell to 15.9%, following a massive 350 basis point reduction in the monetary policy rate to 18%. That's a huge move. But rewind to November 2025. The GRR had actually increased slightly to 17.96% from 17.86%. Why? Because Treasury bill rates ticked up from 10.5% to 10.67%. Financial markets were holding their breath. October 2025 saw the GRR drop by 2 full percentage points, from 19.86% in September. This continued a steady downward trend throughout the entire year. The rate, which stood at 29.72% in January, rose marginally to 29.96% in February, then steadily declined to 19.67% by August. It's been a wild ride. Here's the imp. The latest reduction could lead to slightly lower borrowing costs for commercial bank loans. Loans contracted in December 2025 are likely to be benchmarked on the new GRR. That means interest payments on new loans should be lower than those in November. Borrowers with fixed-rate loans are unaffected, but those on variable rate agreements may see small adjustments. But here's the tension. The decline comes as many businesses continue to face tight credit conditions due to a liquidity squeeze. This squeeze is driven by measures to curb inflation and stabilize the economy. It's a delicate balance. The latest monetary policy report shows average lending rates have already dropped from 26.6% to 24.2%. That's a sign of an easing credit environment. The Bank of Ghana also notes declining money market yields, with the 91-day Treasury bill rate falling from 13.4% in July to 10.3% in August 2025. This is a system working. The Ghana reference rate was introduced in 2017 by the Bank of Ghana and the Ghana Association of Banks. It provides a transparent benchmark for determining lending rates. The first GRR, set in April 2017, was 16.82%. It replaced the old base rate model to provide a consistent and open framework. It remains the central guide for interest rate decisions across Ghana's entire financial sector. So what does this mean for the average person? Some say it's a sign of a recovering economy. Others warn it's a fragile victory in a long war against inflation. But one question remains: will this downward trend continue, or is another spike on the horizon? Do you think lower interest rates will boost Ghana's economy? Drop your take in the comments. Subscribe to Kenya News Update today for more breaking financial news from across Africa.